Joining us for the first time, thanks for tuning in for the Market Chameleon pre-market show with the main man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer? It's up there for everyone to enjoy.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or call your broker. That's what they're there for, to help, to give you advice, give you guidance. So there's the disclaimer.
All right. What's moving this morning?
So, yep, if you guys are joining us for the first time, what we'll do today is we'll take a look at the pre-market report. But if you guys have any questions, it could be Market Chameleon tools, data analytics, strategies, whatever question you have, you can put that in the live chat. Will's monitoring them. He'll read it back to me. If you want to come and ask your question live, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. When you get to Zoom, click on raise your hand. This, you don't have to turn on your video camera, but you'll be able to ask your question directly. While we're waiting for any questions to queue up, what we'll do today is we'll start out with the pre-market report, see what's trading pre-market hours, maybe take a look at some of the earnings that have been coming out. And if any questions come up, we'll take those as they come in.
So it looked like that Netflix made a big move after earnings, didn't it?
Right. So we'll take a look at that. That's right now we're on the pre-market report here. These are stocks trading at pre-market hours. I do see Netflix on there. So right now we have our most active stocks, a list of our most active stocks, biggest percentage gainers, biggest percentage decliners list. I see Netflix right here, number 2 here, down 27.7% in the pre-markets. That's, after they reported earnings last night. Couple other ones that are sticking out. I see Roku down almost 8% in pre-market, Disney down 5%. So some of those are probably going down in sympathy with Netflix. And I believe that that's either the biggest drop Netflix had. We'll take a look after reporting earnings, in history, or maybe, the second biggest. We'll take a look in their history. So almost losing, 28% now in the pre-market hours. And what was I took a look at it. What was the big shocker that they haven't gained on net?
I think they lost subscribers.
So they lost subscribers, not a lot, right? But this is the first time that they lost subscribers. And then it's down big. And some of it might be even with, Ukraine and Russia, because they lost probably all those subscribers at one time. All right. That was just them pulling out. So I wonder if that had anything to do with their numbers coming out. But I'm also reading that they're trying to come up with a new model, perhaps something like, Hulu, or what are the other ones? Tubi, like they have these.
Yeah, well, Disney has one.
With an ad, right? Like if you run, if you use both ad and subscription. But even if they do at this point now, they're starting to feel like maybe they lost their competitive edge, and they have to basically compete on everybody else's level. So maybe that's like the big deal right now with why they're so nervous. And I think that they had still a pretty high valuation the last time I looked, like if we're comparing them, price versus sales. We could take a look at that later.
It says in Barron's, in the US and Canada, the company lost net 640,000 subscribers.
Oh, just in US and Canada. Okay.
That's what it says, yeah.
So that's good. I think they also said that there was a lot of sharing of passwords.
Yeah, that's a big problem.
Yeah, and if they're gonna clamp down on that, that means people are gonna have to, start paying for the service. And just yesterday, I was reading an article, and sometimes I just go and read the comments with people, and people were just not happy with that. So I guess there are a lot of people sharing passwords, and a lot of negative comments about that because they felt like that was one of their sales points, Netflix. So we'll see how that works out. Let's filter out this list, narrowed down to S&P 500 stocks, see what's going on in the S&P 500. So what I'm going to do is, because right now this list has all the small cap stocks, ultra ETFs, closed-end funds, rights, all of them are in there. Let's narrow it down to S&P 500 stocks, get a better picture of what's going on there. So I'm going to use the filters up here. This one in ETF, drop it down by selecting SPY, that's the S&P 500 ETF. And this list will get, I think I got to refresh here. I haven't been on this screen for a while, but let's try that again. Select SPY, and this will filter out the list by the SPY holdings, S&P 500 constituents. So we see here 13 made our percentage gainers list, 10 on the decliners. So pretty even, maybe slightly more towards the bullish side. And here we could see Netflix, Disney, we just talked about them. IBM looks like they reported earnings up 2.6%. NVIDIA bouncing back a little bit, up 1.3%. Twitter, that's constantly in the news, up 1.2%. But I see a lot of chip stocks right now on the list. So it looks like, chip stocks up in the pre-markets, the streaming services kind of down. Not much more here that's popping out at me. Well, if you don't have any questions on the pre-market, maybe I'll just go to the earnings page, see what is going on there.
Yeah, let's check out the earnings.
All right, so I've been coming to this page because it's new. This is going to be our first earnings quarter using this page. And as we were saying yesterday, what this page will do is update after the morning, and it'll create a list of stocks that are expected to report earnings today after the market close or tomorrow before the market opens. Right now, because we're not open, this is looking at yesterday's list. And it gives you a quick visual from an options perspective, what kind of premiums people are pricing into the expected moves. So here we do have filters that could change this list. It's set to, by default, stocks that are $25 or higher or above $25. And on average, the stock has to trade 2,000 option contracts per day or more. So this way you get a little bit more of the liquid options. And the reason we're doing it is we're looking at the options, and we're looking at the straddle and interpolating what are the traders expecting the earnings move to be. So if you're buying the call, you're buying the put, you're buying premium in both, and the stock has to move in either direction to cover the cost of both options, call and put. So to the upside, it has to go up enough by a big enough percentage to cover the cost of the put, because at expiration, it'll be worthless if the stock goes up, and cover the cost of the call. Same thing to the downside. So when we look at these little blue dots here, and to the left, you could see this is the percentage, the implied move. So these are the, how did I do that? All right, these are the implied moves over here. So this blue dot here is saying Netflix yesterday, the straddle was implying a move of 10.9%. So you can see the straddle way underestimated today's move. Over here, BKR was estimating a move 10.3%, Procter & Gamble 3.1%. So you could compare this group of stocks and see what are the expected moves, why are they distributed this way. The reason is we also put in a benchmark to compare what the options are implying versus a historical benchmark. So over here, we have this is down here is shown the historical benchmark based on what we have selected. So right now, by default, it's selected to compare to the last 12 quarters average move for that stock. Okay, so Netflix on average, you could see moved 7.1% up or down in the last 12 quarters. So it's out here. So this right here, this orange line is the benchmark. So you can see it's above. IBM, you can see yesterday, the implied move was 4.7%. On average, it was 4.8%. So it's right on that line. So when it's on that line, it's on its historical benchmark. When it's above the line, it's above its historical benchmark. If it's below that orange line, then the implied move is below the historical benchmark. So that's how they lined up yesterday. Since these stocks reported yesterday after the close or today before the market opens and the stock's starting to move in pre-market hours, we also draw a line to show you where it's moving right now. Obviously, it's going to open, the stock could keep moving, could go up or down by more, but where is it now relative to where the options were expecting the move to be yesterday? So you see Netflix, that line is going way up because the move is much greater than the options were anticipating, right? Options were anticipating a range of 10.9% in either direction. It's down 27%. So that move way higher than that range. IBM right now, line's pointing down because the expected move, the range was 4.7%. The stock's up 2%. So that move right now is within the range or inside the range of that, what the options were expecting. So that's how to read this chart. You could see there's a lot of visually, you get a lot of information right here, right? So this can avoid a lot of doing a lot of stuff, going page to page. We put it all here. And you could change these benchmarks. So if you drop it down, we could compare it to biggest opening moves. So if I click on opening, 12-quarter opening gap, you could see here that Netflix, I picked the max gap, max opening gap. So this is not the average. I picked the biggest opening gap move. Okay. In the last 12 quarters. So you could see Netflix is implying to move yesterday at 10.9%. The biggest opening gap move in the last 12 quarters is 21%. Right now it's down 28%. So that is above that benchmark. See, even the max. Let's see the max all time. I'm going to do max historical opening. So that's not the biggest opening gap ever, Netflix. So you could see that's even today's is below the biggest, looks like the biggest gap move in its history was 39.4%. Right. So that's in all, and that could have been 10 years ago. We'll take a look at it, but that's in all the history that we have right now on our record. All right. But that's one way you could use these different benchmarks to reset it and get a visual of what's going on. All right. There are no questions on there. I'll start moving on. We did talk about this yesterday. If there are no questions, maybe I'll move on to a different report, Will. But I'll try to come back to this more and more as the earnings go on.
We did get a question from Michael McCrae that popped up. He's asking, how many days back can you go for average option volume?
How many days back can you go for average option volume? I'm not sure. I'm not sure I understand that question. So the average volume is just taking it's like you take 90 days of, let's say you take a 90-day look back period, right? And you take the volume for those days, sum them up, right? And then average them out by the number of days. So that's an average volume. So when we compare the average volume, like let's say for 90 days today, we'll look back 90 days from today, look at every day, sum them up, divide them by 90 days to see on average what an average daily volume is. So if you wanted to look on daily volume, let's just say like SPY. On SPY right now, if you go to historical data, right, on this side you have stock data, on this side options data. So here's daily volume, right? These are the daily volumes, the percentage calls, puts, open interest, and you could download this and make, calculate any average you want. You could do 10-day average, 30-day average, you could do a moving average if you want. So you could download it and kind of, but you have the history here, right? And then you could manipulate it any way you want to do it. So I'm not sure what by average, history of average daily, but maybe he meant like daily volume.
Yeah, he said thanks. So there you go.
All right. Let me take a look at Netflix while we're waiting for more questions to come up. So this is on earnings. So let's take a look at it here. So we see here yesterday, the options implying 10.9%, it's down 28% right now. The options did, and here's another thing, the options did overestimate the move 62% of the time, right? But when there was a move, it was very big. So you could see here that the actual moves exceeded the estimated moves on average. And let's take a look here. So this chart here, these bars, they're showing us the expected range of the stock. So you can see here the percentages here. The bars are where the expected range up or down based on the options markets. When the red and the green are the actual moves. So the red, the actual move to the downside, the green, the actual move to the upside. So here I'm hovering over January 19th, the actual move to the upside, 16.9%. Straddle was implying 6.4% move. So you could see it exceeded to the upside. So if you sold the straddle, you would have had to buy it back higher the next day for loss. If you bought the straddle, the stock covered the cost of it. So Netflix, I mean, even if you're looking in the last, I think these are 13 quarters, there are only 2 quarters that the stock was actually up after reporting earnings. So I see just a lot of red, so it looks to me like this almost since 2019 has been the theme that the stock has been having, under pressure after reporting earnings. And this is like 1, 2, 3, 4, 5 earnings in a row that the stock was down after reporting earnings. So, just looking at this data, it looks like, it's not a big shock, right? It looks like they've been having some issues just looking at this.
Now, how's the stock tend to perform the days after earnings?
So let's take a look at that. So this is the stock patterns. So here we see these are the last 12 quarters, right? And we see that on average, 82% of the time stock gap lower, 18% higher. On average loss 3.4%. The average move 6.8%, right? So this is way higher than history. And the biggest one in the last 12 quarters, biggest down move 21.3. So that was last quarter. Today's would be worse, 28%. This is what the stock tended to do after the open. So wherever it opened, gapped down, gapped higher. From the opening price to the high of the day, the average move was 1.8%. From the opening price to the low of the day, average move was down 2.7%. So to me, it looks like after the open, pressure was a little bit greater toward the downside than upside, because if you look at that range, the downside, the average move was higher by almost 1% than the average move to the upside. The drift from the opening to the close, 64% of the time it closed lower, 27% higher for an average loss of 0.8%. The move, from the opening price was up or down 1.6%. So you could see what the volatility was like, for the stock after the opening. And here's the last time, down 21%. We see from the open to the high, the last move, it was up 2.3%. From the open to the low, down 5%. So the move to the downside was 2 times greater than the move to the upside. This is what it tended to do after reporting earnings. So today, the stock, wherever it does, it ends up, closes. What does it do the next day, the day after, 2 weeks later? So here we see that, to me, it looks like it's more often weaker. So here I see 64% of the time it's down, the next day 36% up. On average, it did gain 0.1%. So I see here, some of the up moves were greater than the down moves. But on a 2-day, 3-day, 1 week, looks to me like it added to losses on average. So more often, there's more pressure to the downside than to the upside. 2 weeks later, 55% of the time it was higher, 45% lower, for an average gain of 1.5%. So maybe the next couple days, next week, we'll see how it is, but it tended to be weaker coming out of earnings. That's what this is showing. Let me see implied volatility. So let's see what the implied vols did. And here's a thing. This is a good example because a lot of people play straddles or strangles thinking they're playing the implied volatility crush. And I always say, if you're playing the front month straddle and strangle, you're not playing the implied volatility crush, because implied volatilities, when the stock moves like this, implied volatilities are not going to matter to you because it's in the money. The stock moved. So whatever the implied vols do today, it's not going to even help out. Implied volatility crush is something different. It's like if you have to hedge the move. So like a calendar spread or diagonal or something, but you're not playing the implied volatility crush. A lot of people get that confused. You're actually playing the move. That's it. When you're doing the straddle, it's either going to move or not move. That's what you're doing. So I'll show you an example here real quick. So here's the straddle, right? The straddle, let's say the stock closed at what? 348. So let's just say here, 347 straddle. You sell the put call. You sell the put, right? So I sold both. So sell the call, 347 call for 1950. Sell the put, 347.5 put for 1810. Let's load that strategy. So you could see here, right, that this is what the payout diagram looks like at expiration. You brought in 3760 credit. That means, that the stock has to finish within that range for this straddle to be profitable. Okay. If it goes outside that range, it's not profitable anymore. So it doesn't matter what implied vols do. You have to buy this back at a loss. So once it moves by more than 3760 away from that strike, it's a loss. like see here, it's down $98. So the implied vols have nothing to do with it. This is not going to matter. It's the premium embedded into the move, right? Implied volatility is different because implied volatility, when you're looking at the Black-Scholes model, assumes that you're able to hedge it, right? And you can't hedge it. You can't hedge your way out of that move because it just closed at one price and it's opening at a different price. So when you're doing the straddles and the strangles, it's not implied volatility crush. It's either it's going to move or not move, enough.
You're betting on whether the premium you bring in is going to be enough
Cover the
to
move.
offset, the move.
Exactly. It's not an implied volatility. Implied volatility is something different. That means you're hedging the moves. Black-Scholes model, that's what it is. You're hedging the moves. When the stock moves, you're hedging your deltas. You're staying delta neutral. You can't do that in a earnings gap, right? You can't do that. So you are playing the move. It's very important. I think people don't, some people say, well, I'll do the, wings, right? So they'll come out and say, okay, well, I'll do the wings. I'll do the, 10% out of the money, whatever let's say 10%, 315 and another 10%, over here, 585. So this way, now I'm playing the implied volatility crush, but no, you're not. You're still playing that the range will be in here. So once it goes outside that range, right, where we are now, where's the stock? 250, right? Here is your break even, 302. It goes outside there. That's it. Your implied vols don't matter. They could go to 0 today. They're not going to help you because that's not what you were doing. You weren't actually playing the implied volatilities. Go read the Black-Scholes model. Go read the binomial. The only way your implied volatility is when you are able to hedge every penny on the way down or every dollar or whatever. You are able to hedge your deltas. Okay. Let me just see on the release dates while we're on Netflix. It is down 28%. Last earnings, it was down 21%. So it did have two back to back, but I'm just going to see when was the last time it moved. These are historical earnings over here. These are the moves. So I just want to go back to see. Here's a 19% to the upside, 18% to the upside, not 20, 24%. Here's a 42% to the upside, 2013. So 23 to the upside. You'd have to go back very far, to see Netflix moving around like it is now. Last thing, I only have a minute. Let's go to the implied vols. So this is looking at the implied vols on a 30-day, right? So this is if you're doing a calendar spread, you hedge the move, you wanted to see if it didn't move enough, if you could get that IV in. So this isn't looking at the from month, looking at a later date month, 30-day constant maturity. So we see yesterday that IV was 59.6, right? Keep in mind, this would have been something you'd have to hedge the move. 59.6, that's where the 30-day IV went out. On average, day after earnings, the 30-day IV is down 26%. So we see day before 49.1. So we were higher yesterday. Day after, average 30-day IV 35.4. 5 days later, 33. Let's just come down here. This is where we are. This is the implied vol. So it's not the highest, right? Like I see October here, to July 16th, it was 64, April 21st, 74. Here's the average, but it's within the high-low range. The last time we said it moved, you could see that next day, the IV didn't even come in, or very little, because of that big move. So you could see here, It went out 47.9 and ended the day 47.5. It was down like 21% last time. You could see here that, yeah, it started to come in 45, 47, but really there's the last time it moved, even the 30-day IV, even the options going out further didn't even come in because the move was so dramatic. So we're at past 9:30. Will, I'm going to stop it there.
All right, great. We did have a question from Jean, who's one of our longest running chameleons on the chat, and she was asking about two, and I want to make sure I get the stocks right. They look like two charger station battery companies. Maybe we can look at we haven't looked at it in a while, but the burn rate, some of these, tech growth stocks that have come way off, one of the questions is how long can they survive, right, going forward? So it'd be interesting to look at that feature. We haven't looked at it in a while. Okay. Well, great job, D. Thanks so much.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
All right. Trade in peace.